Welcome back, guys. Today we're going to analyze Nexterra Energy. This is a renewable energy utility company, which is pretty cool because we are moving in that direction as a world. We're going to renewables at some point, and this is a growing company in that space. So let's check out the 5-year chart. They are up 41%. They have slightly underperformed the S&P 500 over the past 5 years. Their all-time chart, I really like charts like this that are just straight up and to the right. They've had some choppiness in the last 5 years, but maybe we'll see some more growth like they did from 2010 up to 2020. That was a 4x, so pretty solid growth there. They are a $139 billion company at this point. Absolutely large energy company. Their price to earnings ratio at 18 is not bad at all, especially when you're factoring in that they're growing pretty well. Although the reason why their price to earnings ratio is so low right now is because last year a they had a generous like tax credit or something like that. It was an unusual expense that really helped their earnings right here. Yeah, unusual income of 3.8 billion. And they also had, yeah, that's what it was. Um, but let's take a look at their financials. They have grown their revenue um, pretty decently up to 2023. From 16 billion to 23 billion, probably about like 6 to 8%. I'm not quite sure. I could do a calculation on that. What, 16 to 23 about over 6 years? We can do this. 16 to 23 over 6 years. It's like a 6% annual growth rate. I would expect that moving forward as well. Their gross margins are pretty decent, and it does translate pretty well into their net income as well. They are diluting shareholders a little bit, probably through stock-based compensation. Let's take a look at their balance sheet because their balance sheet is very important. They have a lot of assets, lots of liabilities. They do take out debt in order to build up their assets, and their net debt currently is 71 billion, so we will have to factor that in. In terms of their cash flow, they have their cash flow is pretty much like flat, mostly because they spend a lot on capex in order to grow their assets and grow the amount of like solar projects that they have or wind projects. So they spend a lot of their cash flow on capex, which is right here, 9 billion in capex. But they still pay a dividend. So they take out some debt, they spend a lot on capex, but they make sure to pay their dividend of 3.7 billion. And they actually did issue some stock in order to raise some money. So not usually the best thing to see is issuing stock, but maybe they thought that their stock was overpriced, and so they issued some stock to raise some money in order to expand the business. Which usually with a business like this, it would probably be better with scale. Uh, Taking a look at their stats, let's look at their ROIC. Their ROIC is about 7% a year. Not that great. Their net margin has been pretty solid, above 15% every single year. So very good on the net margin. I did look at their presentations. Here they're expecting 6 to 8% in their earnings growth, and they're expecting 10% growth in their dividends moving forward. They have, this is their energy mix, I guess. They own Florida Power Light Company, and that's 70% of their revenues or assets. Yeah, of their assets is FPL, and then 30% is their Nexterra Energy Resources, and this is their Florida Power and Light Company. They've got assets all over Florida, and most of it is solar. They don't have any wind, it looks like. They've got some battery assets. They've got 2 nuclear assets, and then they've got a few natural gas power plants as well, it looks like. Or maybe it's not natural gas power plants, but maybe it's natural gas distribution. Um, but yeah, mostly renewable energy, that's for sure. And then we've got the Nexterra Energy resources. And a lot of this is wind. 63% is wind and 18% is solar. And it's all over the United States and some in Canada as well. Yeah. So, and 83 billion in total assets for their Nexterra Energy. Let's look at the analysts, what they're thinking. Well, they're projecting 3.4 earnings per share, going up to 3.68, and their revenue staying flat for this year and then growing 8% next year. In terms of their stats, let's look at their short percentage, and their short percentage is only 1%, so not bad at all. Yeah, with a business like this that's pretty consistent, their moat is basically that they own the transmission lines, they have their power generation. Other companies can do power generation, but they probably know how to do it very, very well. So short percentage of 1%, green flag there. Insiders as well have been buying. So here it's been only buying, no sells, and 75 million bought in Q4. And that was by the major shareholder here, 74 million. And then we've got a director buying. Yeah, the CEO bought some shares as well. So lots of different people buying shares in this company from the insiders. So that is a very, very good sign. And they were buying in 2023, which was pretty much the peak of the stock. So you might be getting a great deal at the price currently. So insiders were buying a lot in this area. And hey, we might be seeing a buying opportunity with this dip. It would, of course, have been better to buy the stock at like $55 a share, but we didn't do the analysis then, did we? Okay, let's check out the spreadsheet or the valuation model I have. And we've got the earnings per share estimate, revenue estimate, buybacks of 0, net debt of 77 billion, discount rate of 10% because I want a 10% return on all of my stocks, exit multiple of 24 because I think that this company has lots of room to grow in the future. And so that's why they command an exit multiple of 24. In terms of earnings growth, I have them growing at 7%. That's kind of what the company is expecting. So I just put that in for every single year. And in this case, we can see the fair share price at $83 a share. And then when you factor in the debt, it's $46 a share. Usually with businesses so consistent like this, the debt is not really that big of an issue. And so I'd put their fair share price around $70, about where they're trading right now. And I'd say if you bought them today, you'd be expecting a 10% return based on this model. And same with the revenue model. 25% margins, kind of high compared to what they've done in the past, but I think they will be able to hit this like pretty consistently, 25% on average per year, and growth of 7% in the revenue. Basically the same as their earnings. This model comes out with the same numbers, 83 and 45. So yeah, this is a solid company, especially if you're trying to diversify away from like some like big tech. Like this is a utility stock, so less correlation with those other stocks. This would be a good company to add, I think. So yeah, let me know what you guys think in the comments, and yeah, hit that like button. I'll see you in the next video.